So here's a real head-scratcher for you. How does a company report growing sales and then watch its stock just fall off a cliff? Well, that's exactly what happened with Lululemon. On the surface, things looked fine, but the market absolutely panicked. We're going to find out exactly what they saw.
Okay, so let's just start with the aftermath. Right after Lululemon dropped its earnings report, the stock took an absolute nosedive. We're talking a plunge of nearly 18% in after-hours trading. Now, that's not just a little dip, that's a panic. Investors saw something that made them hit the emergency eject button.
But this is where it gets so weird, right? Because at the same time, the company announced that its total net revenue was up 7%. I mean, up is up. So what gives? Well, as you know, with Wall Street, the headline number is never the whole story.
This is the big question. What on earth did the market see that caused this full-blown meltdown? There's a huge gap between that plus 7% number and an almost 18% stock crash. So, let's put on our detective hats and dig into the real story.
All right, first up, let's just take a second to absorb that stunning stock drop and see what clues we can find. Now, to really peel back the layers here, we have to look closer at the numbers. And the first big clue, well, it's a tale of two very different markets for Lululemon. Okay, check this out. That overall 7% growth number, it's kind of hiding something huge. If you look at their international sales, they were on fire, up a massive 22%. Amazing, right? But then you look at the Americas, their home turf, their biggest market by far, and sales were up just 1%, basically flat. So all that awesome international growth was just papering over some serious cracks at home.
And believe it or not, it gets even more telling. When we look at what's called comparable sales, which is just a fancy way of comparing stores that have been open for a while, so you get a real apples-to-apples look, sales in the Americas were actually down 4%. So the U.S. business wasn't just stalling, it was actually going backwards.
Okay, so we've established the problem is clearly in the U.S. market. But why? What happened? The best part is, we don't even have to guess. The CEO himself, Calvin McDonald, got on the earnings call and basically laid it all out for us. And boom, there it is, straight from the source. He basically said, you know what? We let our stuff get stale, especially in their core lounge and casual wear categories that have been so popular. They just relied on the same old playbook for way too long. And he didn't stop there. He went on to say they became predictable, that they missed the boat on creating new trends. And, in the world of fashion and apparel, that's practically a death sentence. If you're not leading the charge, you're getting left in the dust.
They even named names, calling out some of their most famous product lines, like Scuba, SoftStream, and Dance Studio. The message here is pretty clear, right? Their loyal fans already have this stuff. Slapping a new color on an old favorite just isn't going to cut it anymore.
So, having stale products is bad, for sure. But that wasn't the final nail in the coffin. What really sent Wall Street into a frenzy was what came next, the forecast for the future. This is where an internal problem collided with an external one to create, well, a perfect storm.
All right, stick with me here. This gets a tiny bit technical, but it's super important. There's this trade rule called the de minimis exemption. All it really means is that if you import something under a certain value, in this case $800, you don't have to pay import taxes on it. Lululemon was cleverly using this by shipping a lot of its online orders from Canada. Well, that party's over. The loophole just closed.
And the cost of that party ending? A cool $240 million. That's how much Lululemon expects to lose in gross profit this year alone because of that rule change and other new tariffs. That is a gigantic, unexpected bill to pay. So you add it all up, stale products, a shrinking U.S. market, and now this massive new cost. And what do? You get a company that has to tell Wall Street, hey, things aren't going to be as great as we said. They had to slash their outlook for the whole year. Revenue growth? Chopped. U.S. revenue? Now expected to actually shrink. Earnings per share? Cut. This is the smoking gun. This is what made investors run for the hills.
Okay, so the situation looks pretty bleak, right? I mean, stale products, a core market in decline, a huge new tax hit, but Lululemon isn't just throwing in the towel. They came out with a clear plan to turn this ship around. And their plan is all about going back to the source, the product itself. It's a three-pronged attack. First, they're putting their new global creative director in the driver's seat to inject some fresh energy. Second, they're cranking up the newness factor, promising to go from about 23% new styles to 35% by next spring. And third, they're getting faster, making their whole system more agile so they can jump on trends instead of missing them. So there you have it. Is Lululemon a challenge giant on the ropes with the shrinking home market and serious product problems? Or is it a coiled spring, a fantastic brand that just hit a speed bump and is about to bounce back stronger than ever? The market, with that 18% drop, has certainly made its call. But the real billion-dollar question is, what's yours?